I'm really excited to be here this evening and really looking forward to what I think will be a really engaging conversation. This panel is really focused on talking about discrimination and other instances that we continue to see in 2020 as it relates to redlining and reverse redlining and fair lending and fair housing discrimination, and what advocates and practitioners are doing on a daily basis to really focus on how do we solve this problem? How do we coordinate with local and national resources to really make sure that we are moving forward and making progress? So thank everyone who is able to join us this evening. I think that you all are really going to enjoy this conversation, and please, by all means, if you have questions as we go through this discussion, please submit them through the chat, through the Q&A, so that we can make sure to try to tackle them through this conversation. So to open up, we have a great list of panelists and speakers who have experience in the financial field in terms of residential lending, as well as advocates that have done research on the kind of issues that we're facing. We know that in cities like Baltimore, Philadelphia, DC, we see a lot of challenges that are related to gentrification and really trying to revitalize those neighborhoods. And so I'd really like to open this up at this time to the speakers to give us a quick 1 minute, maybe a minute and a half overview of how your work really relates to this space and how you see it at present as we're working to move forward. So you all can feel free to jump in, or I can certainly call on, and perhaps Washington Harris, Bruce can get us started.
Sure. Well, thank you very much, Jasmine, and thanks to the organizer for inviting me to participate on this panel. My name is Washington Harris Bruce, and I'm the current president and CEO of Baltimore Community Lending. Baltimore Community Lending is a CDFI, which is Community Development Financial Institution in Baltimore. And we are a mission-based lender. Our focus is on lending to low-income neighborhoods or disinvested neighborhoods, to work with small to medium-sized developers to do renovations and for single family and home ownership units. We have 2 loan funds. We have small business lending as well as real estate lending. And our focus is ready to help borrowers who have not been able to access financing from traditional lenders. My background is very diverse. I've been in the community development finance field for over 30 years, working with various commercial banks around the country. So I have both national and international background in community economic development finance. So it's an opportunity to be on this panel and to share my experiences and also work to provide resources in terms of capital, technical assistance to small business as well as real estate developers. Now, as it relates to what we do, as it relates to the movie, we are a mission-based, and we want to make sure that we can invest in those communities that have been disadvantaged for many years with our flexible financing. So thank you.
Great, thanks so much. And I believe we also have Dr. Seema Iyer joining us as well. Dr. Iyer, would you like to introduce yourself?
Hi, yes, Seema Iyer from the University of Baltimore. I oversee a project called the Baltimore Neighborhood Indicators Alliance, which puts out a lot of data for all of our neighborhoods in the city of Baltimore every year. And I also oversee the Real Estate and Economic Development program at the University of Baltimore, which is an undergraduate degree in real estate. And for many of our students, they end up wanting to be the kind of developers that BCL will eventually lend to.
Yeah.
They come from Baltimore. They're trying to figure out how to actually create sustainable development businesses in what may seem like challenging neighborhoods from a real estate market. But if we can incubate them and actually show them the ropes, there's a lot to know about how to develop in neighborhoods like Baltimore. We have a lot of interested people that want to do this work, and that's the critical kind of bread and butter for our neighborhoods. They need people to continuously update the real estate. They need people to continuously be investing in our neighborhoods, and once that stops, it's a vicious spiral downward. So I saw a lot of that in the movie too, and we can talk about that.
Yeah, absolutely. Thank you for making that connection. We also have Monica Mitchell joining us. Monica, if you'd like to introduce yourself.
Sure. Thank you, Jasmine. And hello, everybody. My name is Monica Mitchell. I lead community development and philanthropy for Wells Fargo in Maryland, DC, and Northern Virginia. I am a Baltimore native. I still live here. It is one of the proudest aspects of my life. I'm also I'm a board member of my fellow panelist organization, Watching Bruce with Baltimore Community Lending. And I'm also the founder of the all-girls charter school, Lily Mae Carroll Jackson Charter School, where we educate 350 girls. And part of our strategy there is also that we own our own building, because it's very important to owning our own destiny as well. This movie was so important because there are a few movies that focus on economic civil rights. And when racism happens on paper, it's tricky and can often be easily deniable. And banking is honestly a very tricky industry. One of the last places that you would have, I would have told you middle school, high school me that I would end up is at a bank. But when I looked at the opportunities to impact the things that I care about around community development, why my neighborhoods were looking the way that they were looking, why the neighborhoods that I would walk, look disinvested in and unchanged, and businesses would close and new businesses would not open 10 and 15 and 20 years later. All of those questions led me back to banking. And so Wells Fargo might have gotten a bit of a Trojan horse when they got me. I don't know, but that's why I'm here. And so to me, the most important aspect of the movie, The Banker, is the fact that without the support of banks, Black Americans are cut off from the possibilities of wealth building. Yeah. And we need to be very intentional about dismantling those rules that are in place and stop that from happening, both written and unwritten.
Yeah.
Great. That's really an excellent point. And I hope we'll talk about that more in terms of just access to capital and access to wealth and what that means about wealth building for communities that are just disadvantaged in many ways. So thanks so much. We also have Tara from Relman Colfax joining us. Can you introduce yourself, please?
Hi, good evening, everyone. Thanks so much, Jasmine, and it's great to be here with you all, and an honor to be on this panel. So I'm a civil rights litigator. I'm a partner at Relman Colfax. We're a civil rights law firm in Washington, D.C. I've done a bunch of work in Baltimore, so it's exciting to be here with you all. And the work we do, I do a lot of fair housing and a lot of fair lending work. So bringing enforcement actions under the Fair Housing Act, under the Equal Credit and Opportunity Act. And we see so often, our firm, and I worked in a case representing the city of Baltimore, actually against Wells Fargo back in 2008, Monica, for predatory mortgages that resulted in, what we ended up seeing was really disproportionate foreclosures in Black and Brown communities that just stripped the communities of wealth, right? And so, and as a result of that lawsuit, and then working, I think in partnership with Wells Fargo, have reinvested millions and millions of dollars into these communities. And that, I think it's one of the only ways that we can, it's by pouring money into communities and into individuals to be able to have home ownership, to have one of the key accesses to building wealth in this country, which is what we see with the banker, right? Which is when you cannot get access to credit, these communities can't thrive. And unfortunately, what we've seen over many, many years is that often communities are deprived of credit or they're targeted for predatory loans. and predatory practices and products, because when they're so starved, it's much harder to access the credit, and so you might not know what you're getting. And so that's the work we do, and it's a real pleasure to be here with you all and to talk about some potential solutions and ways to keep enforcing these laws and to make sure that we're holding all of our lenders and our developers and our municipalities accountable for their obligations under the Civil Rights Act.
Great. Thank you so much. And you bring up a great point. And again, we're going to talk about that a bit more in terms of just access to credit and what that means. And we know that the movie took place prior to the passing of the Fair Housing Act that included lending, which may have changed the story a bit, but the story is what it is in its own phenomenal sense. So thanks so much for bringing that perspective into the conversation. And we also have Sally Scott, Dr. Sally Scott, joining us. Dr. Scott, can you introduce yourself?
Yeah, thank you, Jasmine, and thank you, Cedric. It's really an exciting panel to be on. A lot of dynamic people here today. So I am the director of the Community Leadership Program at University of Maryland, Baltimore County. It's a recent move for me. I've spent many years in the community development field, worked for a foundation, worked for citywide nonprofit in Baltimore, and also had a stretch founding an affordable housing coalition in the Midwest. At all steps along the way, it struck me that there's, overt racism, which remains a potent force in our country, but then there's, what we've all come to recognize very deeply as the structural racism. And I think what this movie showed was really both. There was tremendous overt racism, but there was also just built-in barriers. And unfortunately, while there have been important legal changes made since the movie, the time that the movie depicts, we still see a lot of structural racist barriers preventing people from the opportunities that they need to thrive, whether it's buying a home or growing a business. Seema Iyer and I recently wrote a paper for the ABLE Foundation talking about overcoming barriers to home ownership in Baltimore City. And, we saw that homeownership is falling among Black Americans in Baltimore and nationally. And it's really down to levels we haven't seen since the 60s. And this is a huge challenge and a huge problem because, homeownership is that step for many people to get their education, to borrow against a house, to build a business. So I think, I don't think we have all the answers. I think we have some recommendations, but I think it's important to think about opportunity and where opportunity is being cut off for people, right now, and where we can do something about that.
Great. Thank you so much. So I'm almost going to dive right into these questions because many of you, almost all of you, actually all of you have dived into what the theme we want to talk about here, just in terms of access to capital, as well as, on a national level, and then scale it down to the local area, for instance, in the city of Baltimore, and what the studies that you all have done have shown, and other instances of how advocates and housing professionals just can be more involved in terms of bringing strategic plans, putting them in place so that there's actually some progress that can be measured. So in considering that, between all of you all have a broad range of experience in this space. And so I'm really curious to know what you all see in terms of what can advocates, and I won't even shorten it down to just housing folks, because I think that we have a lot of community development folks who may not be just strictly housing, but just because we're interested in the access to capital issue. And I know it was just mentioned about wealth building for African-American communities, for Hispanic communities. Like, that is the easiest way or the best way to really help build generational wealth, which is what we're looking for. And in that, revitalizing these communities. So as consumers and as professionals, we continue to find instances of discrimination, even in 2020, in attempts to access capital and to build wealth for themselves and their families. What can professionals and advocates in this space do to be effective in aligning their goals and objectives with, for instance, financial institutions? So that could be a bank like Wells Fargo. It could also be a CDFI. But what can be done to align these goals and objectives in a way that would have more of an impact sooner than later, working to return to just a sustainable state and space for these communities?
So I'm happy to start off with that question. And I would actually argue that we I don't think we've ever been at a sustainable place. I think hopefully we get to one, but I don't think we've ever been at one.
Agreed. I can get that.
I would, one of the organizations that I do a lot of work with, and I'm also on the board of that organization, is one called Associated Black Charities. And they've done a lot of work around the racial equity lens and being able to create tools that help organizations apply a lens to policy. And so speaking as an organization, I think you can have a lot of well-meaning people, but when you're going up against structural and systemic racism, well-intentioned people are not enough without the tools that help to really take a look at policies. And that's exactly what Associated Black Charities put into place. And so they have this tool that we've started to use within our organization over the past couple of years called 10 Essential Questions for Policy Development, Review, and Evaluation. And that tool requires us to ask ourselves, how is an equity lens incorporated within a specific policy? Does a policy explicitly account for potential racially disparate outcomes? If so, how are we addressing those issues? Is an equity lens incorporated into tracking policy outcomes? Because again, you can have, what you thought was a perfectly fine policy, but then disparate outcomes. Are you looking at that? And then once you see and notice those outcomes are disparate, what are you then doing to address those immediately? And then how does policy increase opportunities for communities of color? Really ensuring that we're leading with race. We can't pretend and approach our business in a Pollyanna way, but realize that that there is an intractable role within our society that race plays. And if we're going to be part of the solutions, we have to be very intentional about how we approach our policies and how we take a lens to our policies and outcomes and evaluation that really creates the space for change within the industry.
Great. That's a really
I just
good
want to
point.
piggyback there. A couple of things Monica said, which is talking about disproportionate impact, right, or disparate impact, and how important that is and how central it is to being able to start to work towards rooting out systemic racism, right? Because not all discrimination has smoking gun of intentionality behind it, right? That sometimes there are policies, and we've created a society that is based on policies that will have disparate impact, right? You look at credit scores, you look at all the different metrics that we use for deciding who gets credit, when they get credit, and what they have to pay back, what their interest rates are, and all of that matters. So that we have Fair Housing Act, you can bring a lawsuit, you can enforce where there's a disproportionate impact, right? If there is a less discriminatory way to get at what the lender wants to get at, then they need to be doing that and to be paying attention to the impacts that their policies and products are having and their rollout in those products and policies. And so that's one of the things we're seeing now with, the HUD is looking at releasing a new rule on disparate impact and really making it much harder to bring these cases. And what we've seen is that lenders are coming out and saying, no, we need this tool. It's important. In order for us to be able to do the work we want to do, having disparate impact is important. We need this to be able to really get credit out across the board. And so I think that's an incredibly important piece that we all have to keep our eye on the ball there and keep advocating for it.
Mm-hmm. Well, I just want to add in terms of impact, what our CDFI has done is to create products that will meet the market demands or market needs. Most lenders have criteria, credit criteria for underwriting loans. But some of those criteria from a traditional bank is more of a handicap to the community we're trying to serve. And some of those criteria is credit scores and collateral. A lot of times, and also so many years, 3 to 4 years of track record. We have a product that we created to mitigate those problems for startups, especially startup businesses. We do not require, we do have a product for those who want to create wealth through entrepreneurship. So we do work with startups, and credit score is not a major impediment. We do manually underwrite, not through a credit score process. Also, we do not require collateral. If you do not have collateral, we have other ways to mitigate our risk through setting aside a loan loss reserve. So we had to think out of the box to be able to serve the communities, because it's difficult to pledge collateral if you don't have it, because those are all the impediments to access to financing. So, but part of the issues is raising lending capital from the CRA-related banks. Most CDFIs have to raise capital, lending capital from CRA banks. And for us in Baltimore, we are disadvantaged because it's a challenge raising lending capital to all lend to those businesses, both for real estate and small businesses, because we do not have headquarters for those commercial banks in Baltimore. So we decided to start looking nationally for impact investors who are mission-based and want to make a difference. And for the short time I've been here, it's been very successful, because we were able to raise funds from outsiders who are mission-based investors versus the local banks that are not headquarters in the market. So that we have to be, I guess, creative and think out of the box if we're going to help people create wealth. And with entrepreneurship and having investment properties or homes, that's the only way people will come or create wealth for themselves or their families.
Great insight. Completely agree. You all made some great points in terms of obviously the theme that we see here in terms of access to capital and ability to have the credit issue. And of course, we know that.
Jasmine,
Yes.
just said that we're having technical difficulties and we're taking a 2-minute break.
Great. So there's been a lot of good conversation and really underlining the theme from the Baker, just in terms of access to credit and in order to be able, as well as capital, to be able to move forward and have a space to build wealth for an individual, for a family, for a community. And I'm really glad that we have a CDFI on this panel as well, because they play such an integral role and a lot of the activity that happens in terms of support for financial institutions, as well as the national banking companies as well. So I'm interested to hear from you all then. You know, we are really struggling, I think, as a country, especially in times of like COVID-19, for 1 second to hone in on the challenges that small businesses and homeowners are facing because of the changing requirements to be able to access capital and credit. If you all have any particular feedback or thoughts in terms of what are some strategies or things that should be in consideration for small businesses as well as individuals who are looking to buy homes right now. And that's just looking through a national lens for just a moment.
Well,
So
one thing I, want to emphasize is, if we're thinking about, people buying homes, is there needs to be a kind of a ladder, a home ownership ladder. A lot of people are not ready to go from here to here. So you've got to find a way to help them. And I don't know, Jasmine, you've worked in this field a long time and helped people do that. And what we saw in the Baltimore study, which I think may apply elsewhere, is that the housing counseling organizations are kind of seeing people who are ready to buy with maybe just a little help, and then a big pool of people who are not ready. But if they can spend a year or two, whatever it takes, getting the financial counseling, maybe being in a home buyer club to support each other, you start to get this ability to go from, really maybe struggling to pay the rent to being able to buy a first-time house. But we need to be able to invest in that process and in those nonprofits and others that are a part of that process and who help staff it.
absolutely. It's a huge challenge for a lot of clients that come in because, of course, they're ready to buy now. And I don't know if you all, I'm sure you remember the big push that was coming just from the industry of why rent when you can buy? But there was no consideration for the fact that you actually have to take care of this after you buy, like it's yours. So you have property taxes, you have upkeep, you have maintenance that just was not really considered. And so with that, absolutely correct. We have to look at there's not just one path, and it's not just going to be a simple move in terms of that wealth building piece. And I don't know about you all, but I know that one piece that I've seen when we do talk about wealth building, that I know that home ownership is obviously a huge one, and it's really important. But there are also a lot of small businesses that individuals are working on and require and need a lot of support. Mm-hmm. And so from that perspective, what do you all see, or what is your experience, if any? And I can certainly go to the next question if it doesn't apply, but how does that correlate? Because you have a lot of small business owners who, perfect example, we're going through COVID-19 right now. A lot of folks had like side businesses that now they're like, I gotta let go from my job. So this side business has become my main business. And now I have to figure out, how do I fund it? And then I can work on building my business credit as well as my personal credit.
Right. Well, I can start with that since we work in that space. We work with a lot of small businesses. When I say small, it's micro businesses. Those micro businesses, many of them do not even have employees. It's just them. So it's rather income producing activity. But one of our requirements to mitigate our risk is to criteria is for them to go through technical assistance. We have to train them and build their capacity to manage a business. It's one thing to say you want to do a business, but it's another thing to know how to manage your business and and generate a profit. So sometimes people have a passion, but it's not really a business. So being a cook does not mean you can be a caterer. You have to know how to measure your success, know what an income statement is, balance sheet, cash flows, and all of that. So that's a preliminary one-on-one business requirement. We do a technical assistance, especially for those who are startups, to make sure they understand what they are going to. But not only that, we help them with accessing startup capital. So a lot of the businesses we work with, we help them grow from being a micro enterprise to a medium. And then, of course, we want to graduate them to a commercial bank because they are not bankable. So as during this COVID-19, a lot of the businesses that were small, of course, retail businesses were greatly affected because they were shut down during the COVID-19 period. So what we've been doing is really working with them to defer the loans and do a lot of modifications to make sure they do not go default. And also we have been working with a lot of foundations to give capital to those banks in form of grants to help them, both the federal grants, PPP, and from the state, the city, and also from private donation, just to help them float during this period of going over. Now we have a lot of new businesses coming online. Just about 10 businesses will be going to loan committee next week. We have a lot of requests, but we are working with them to make sure they understand what they are doing. So because we are not a commercial bank, we are not regulated like a commercial bank. Being a CDFI, we can be more flexible. So we work with both for-profit and nonprofit businesses to make sure that they have the credit that they need, and also training pre and post. After they get the funding, we'll also follow up to make sure they are producing as agreed. So that's the main thing we do doing right now, to keep people doors open. Yeah.
Jasmine, I also think, in addition to what Watson said, it's really important that banks are there to support CDFIs and stand in the gap where banks are not able to do that lending as well. And so, Wells Fargo and other major institutions have, done significant investing in CDFIs and created different programs. We have programs like Diverse Community Capital and Open for Business that we put out even before COVID-19, and then have leaned into that since COVID-19, that recognize that CDFIs really serve in a unique and grassroots level space to be able to provide that technical assistance to small business owners, for them to either, start their business. Maybe they had a business and they need to pivot due to, restrictions around COVID-19. So that's critical. The other thing that I would say, I know we don't have anybody from Harbor or another Black bank on, but I just want to emphasize the importance of minority deposit institutions as well. We are blessed to have one here. We saw a dramatic decrease in the number of minority deposit institutions following the 2008 financial crisis. And, although we do have, Harbor here, Industrial in DC, those serve in an important role. And we get, again, tying it back to the movie, saw the importance of Black-owned banks being able to deliver that capital to Black communities that, was just long, prohibited, and the rules were set up to keep people out of that. And then there was one moment in the movie at 15 minutes and 30 seconds in where he was doing the first deal with that guy to buy that building, and they went in 50-50. I forgot the guy's name, but the Irishman. And he ended up backing him on the deal because he asked him, you don't follow normal business customs, do you? And, Bernard said, no, that wasn't following normal business customs. And he said, I like that because normal business customs are in place to lock people like you out. Right. And we have got to realize that reality. And so the third thing that I would say is that we also need to look at collective economics as a strategy to get around some of these things. If it's not going to work going straight through the door at the bank, then you may have to find some like-minded people that are able to pool some money together and are willing to invest in an idea. I know that when I bought my first investment property, it was in Baltimore. You can buy a house for $50,000, $60,000, but banks will not finance investment properties. They would approve me for a $250,000 loan, but they would not approve me to buy a $60,000 property because the property value was not enough for them to justify doing the loan. And so I was being responsible and trying to be rent out an affordable home to somebody. And the bank was like, okay, no, we'll lend you more money than you need, but we're not going to lend you this little bit of money to get this property. And so what I ended up doing is, going in with my, pooling resources within family members to purchase that first property and bypassing the ways that didn't allow me to do it through those traditional business customs. So, like I said, CDFI and bank relationships, I think, are critical. Minority deposit institutions are critical. And then recognizing our own power within collective economics.
I'm so glad you mentioned that, Monica, because for the first question that you asked about how do we revitalize stressed communities, part of the problem is that if we don't get capital into the communities that are stable right now, they will go into distress.
Right.
So we have stable communities right now where the housing stock is worth, a decent house is worth, $80,000 to $100,000. That's a legitimate sale of a house, but people have to go into those houses with cash.
Mm-hmm.
Only very few kinds of folks can come in with cash. We have a great neighborhood in the west side of town called Howard Park, where the vast majority of houses that are stable, good houses go for cash because there isn't anybody living at that level. And if we don't
That's where I live.
Oh, there we go. Oh my God, that's so funny. Howard Park is our poster child of if we need to get smaller mortgages flowing into that neighborhood, because otherwise there's no way to sell them on the market. And then you won't get families with children in that neighborhood where they're actually constructing a brand new school. And so if you don't get people with young kids that can't possibly put down, $80,000 in cash, how are you going to maintain the school? So it becomes a vicious cycle if you don't have different kinds of retail options for different kinds of neighborhoods.
Right. Well, I have to add something to what Seema said, because we are working with her and University of Baltimore now on developing young developers who want to learn the business, because part of the challenge too from Baltimore, we do not have a lot of experience or small developers are being groomed to grow in this business. So Seema's program is working with us to make sure we work. She's training them, but they are working with us to access financing and start from small. As a matter of fact, we are closing on one of your students next week, one of the loans from her graduate. So that's an excellent program because they are being mentored, trained, and get a coach during this process. But they are being given the opportunity to access financing to do renovations on vacant properties. There are a lot of opportunities in Baltimore to do renovations, but a traditional bank will not lend the first money because of no value in those properties. So CDFI are in the position to take those risks because we are not a commercial bank. We take those kind of risks to give financing to developers to go in and renovate a building that's below market or a banner or border up to add the value until the after rehab value, then they can sell the homes or rent to homeowners. But in essence, without those type of financing going in first, no bank is going to give the mortgages. So that's a great relationship also.
So let me just quickly plug that this year's competition is on September 17th. And if you want to be inspired with people that are trying to do this hard work, I highly recommend coming to our virtual pitch competition. But I wanted to go back to your question about small business. I don't know about all industries, but the real estate industry is something that we've got to work on right now. The housing prices have actually gone up during the pandemic, and housing sales have gone up for some folks. We don't know kind of where that's happening, but that's actually something that we need to get some data on now, so that the inequality that we already had in our communities is possibly only getting worse with who's owning, who's buying, and who's getting access to capital. So we have to pay close attention to that data right now.
I think one of the other areas we need to focus on is, Watson mentioned the valuation. You know, in the appraisal industry, it's just largely a white male industry. And so being able to diversify that industry, I think is very important because that appraisals in and of itself are a nasty cycle. And it happened to me when I was refinancing my home, that they vastly undervalued my home. But for my knowledge in the financial services industry and, you know, keeping close track of real estate sales and whatnot, and to Seema's point, living in an area like Howard Park that's been a largely stable homeowner area, but has also seen underinvestment, you know, I had to fight to get the value that my home should have been. And so if folks don't know that they could go back and appeal an appraisal, they may be losing $10,000, $20,000, $30,000 or more in wealth on a transaction. And then that transaction then leads to the next person losing wealth on their transaction. So it's really important that, that we're able to make sure that that industry is also reflecting the diversity of our communities.
Well,
And
sorry.
that's okay. Go ahead.
I just say while we're making plugs, I mean, we're in this kind of amazing moment in Baltimore where we have a new mayor coming in, a new comptroller, and a lot of new city council folks, and who several of whom, are very youthful and energetic. So I think, we have this chance to kind of rethink that housing ladder, the whole affordable housing system, both rental and home ownership, and take that step back and take a really deep look at the different aspects of it, because we know there are city policies that are inhibiting people from getting a hold of vacant properties and doing the right thing. If you just want to, get a vacant property, flip it, rent it out, and not really care about the neighborhood as much, that seems to be easy to do. But for folks who want to do the right thing and really invest in those properties and either make it a nice rental or make it a home ownership opportunity, it's harder than it should be. And we know there's the cost of shells in Baltimore right now is actually going up significantly because the ones that went through foreclosure have gone through the pipeline. And in a city with 16,000 official vacant properties and many more, that doesn't make any sense. So there's some kind of places where it's not making sense right now, that it's more than just a market issue. There's really some policy bottlenecks, capacity bottlenecks that I think our new city government folks could do a lot about if they looked at it and really looked at it comprehensively.
Completely agree.
Sorry, go ahead, Jasmine.
That's okay.
One of the things that we've seen is that with the real estate owned properties, that servicers are often not keeping up those properties, particularly in minority neighborhoods, in the ways that they should be. And so then the curb appeal and the actual stability of the homes really goes down. And so to be able to get people to invest and buy those homes, which are often a little bit easier to access because they're real estate owned. But if you're not maintaining the homes and keeping them up, it makes it much harder to access good housing stock in those neighborhoods where you really want people to be buying homes and reinvesting and coming in a more permanent way.
Absolutely. And I'm glad you brought that up, because that's an issue that I know when I was back in Chicago, that we did a lot of organizing with an organizing group in the area to specifically focus on that issue of, okay, it's an REO property, real estate owned, and there's no upkeep. So all of the other property values are being pulled down, in addition to the fact that it's a predatory loan on most of these properties. Evanston, Illinois, is a prime example. That is a very, it's like a middle class, a lot of middle class African Americans. That's where they moved to, right outside of Chicago on the northern border as opposed to the southern. And there were a lot of, I remember going to a client's house, and it was a standard kind of ranch home. And when I looked at her closing documents, which you would be surprised, or maybe not, how many folks do not look at them or don't keep up with them. But her mortgage, the truth in lending, showed that she would have paid $1.1 million for that house by the time it was paid off. And she was 67. So she refinanced that home, and was definitely given a loan that just was completely not affordable and did not take into account her ability to be able to repay. And it was not comparable to the sales that had occurred in that area, at least within 120 days. So that's one challenge that we have to deal with. There's also, I know that Monica mentioned the issue about appraisals. I don't know if you all saw the article in the New York Times today, or was it yesterday, the 25th, yesterday. This Jacksonville family, African-American husband and wife, that they listed their property, or not listed, apologies. They wanted to refinance their properties, and an appraiser was sent out, and the appraiser did an assessment, and they were very confused with the appraisal that came in. I don't want to misquote the dollar amount, but I will say this. When they had an appraiser come out the second time and they removed all traces of, using air quotes, quote unquote, blackness, the appraisal increased by 40%. Wow. Simply just by, I think it went from about 330,000 to about the mid to upper 400s of how much that property was appraised for. So the appraisal issue is another item that we didn't, or at least, we think, again, at least for me, that, we're in 2020. We are almost, we're definitely 50 years past the Fair Housing Act and fair lending, and we're still seeing these same issues. So with all of these things being said, I know that we're coming to the close of this really good conversation here, but I would love to hear from you all, and I think the audience would as well, in terms of what do you all see as viable and really meaningful next steps to be able to address some of the issues that we've discussed here. So we've talked about redlining, reverse redlining, access to capital and credit, and that's in small business as well as residential home ownership, appraisals. What do you all in your everyday, because you all work with this on an everyday basis, have completed studies on this, what do you see as good next steps that anyone from, like, someone who's an advocate that has really committed a lot of time to this, to someone who is just really concerned about the community that they live in, and that they know, well, I want to see this area thrive, but I'm not sure where to start and what to do?
So my recommendation, it requires a lot of reading, but would be to familiarize. I would encourage every community member, every concerned citizen to familiarize themselves with the Community Reinvestment Act and familiarize themselves with the financial institutions within their communities' responsibilities, and publish reports on CRA. The banks are required to give that information to you upon request, or direct you to where you can access that information. That information will allow you to find out the mortgages, the small business loans, depository resources that are happening within your community, down to a census tract. And with that information, you are able to hold financial institutions accountable. You do not only need to access it, or you can access it from any bank. You do not need to bank with the bank to request that information. And it is probably one of the most empowering pieces of information that a community member can get to ensure that the financial institutions within their community are doing what is federally required under law. So I would absolutely say that. And then the second thing that I would say is utilize the Office of Civil Rights and Equity to, to lift up and make reports and complaints. When you see something that's not fair, let's treat it like Homeland Security. If you see something, say something, regardless of what position you're in within the community. Because if we don't report these things, then they're just too easy to repeat themselves. And if it happens to one person, it's probably happening to thousands of people.
Right.
Great points.
I would just encourage anybody who's politically active, whether that means you talk to your city council people, your mayor, your congress people, put this higher on their agendas: access to capital, access to affordable housing.
Right.
There are actually some great plans out there at the national level that would substantially bolster what we can do at the local level if they got passed.
Right.
But even locally, if your city council person knows that this is something you really care about, that's gonna, and there's more than just you in your neighborhood, you get your friends talking to them as well. This is something that they can then take back and start to advocate for at the council level and with the mayor, because we really need to have, I think, a more all hands on deck approach to this issue.
Mm-hmm. Well, I would come in next and say my recommendation also would be for people to be informed. It's so important to know your rights. And in order to advocate, you must be educated. You must know what the rules are. Going back to CRA. CRA is written, it's on the books, it's a law. But if you don't know what it is, you really cannot take advantage of it. CDFIs were created to help meet some of the deficiency, or I guess gaps in the financial institutions, because a commercial or regular traditional financial institutions cannot do what we are doing. We are there to fill the gaps because traditional financial institutions are highly regulated. But our challenge in the CDFI industry is having accessing lending capital from those CRA banks. Not all, but some of them, they rather give you CRA related grants than investments. So what we need is investments, not just grants. We appreciate the grants, but it would not provide capital to a small business or purchase a home or give capital to a developer. So I would encourage you all to talk to your elected officials to make sure to start looking at these local banks in Baltimore for the CRA requirements, because we are not benefiting from them. Very few of them are responding to our needs to raise capital to on lend to small businesses or developers. So that would be one in terms of access to capital and also education. But another thing, to rather invest in the young people, the new generation. We need succession plans. We need young people getting into community development and understanding what it means to keep being involved. It takes the local practitioners to make a difference, to have passion. So we need to train our young people to get into the community development field and to make a difference, make it a profession instead of it just being like a regular job. But you have to have the passion and willing to make a difference in your own community. And we need to form partnerships and collaborations from public-private partnerships. That's part of my goal or organization's goal, to make sure we form partnerships with mission-based organizations like ours. Thank you.
Thanks so much. So I know that we have come to the end of our panel here, and thank you all. This was a really engaging and great conversation. There's a lot more work to do in this space. So I know that we will continue to be busy here. And thank you all for joining us this evening, and have a great night.